Somesh Dash is back, joining us today from Menlo Park. He's the general partner at IVP, a late-stage venture firm backing breakout companies on their path to become market leaders. Somesh has led investments in multiple unicorns, including Rubrik, Discord, Glean, Abridge, and Amplitude. Before joining IVP nearly 2 decades ago, he held roles in corporate finance and venture at CFSB, Technology Group, and Luxme Capital, as well as Sony Entertainment Television. Somesh, welcome back to the show.
Nick, good to see you again. It's been a while.
Always good to see you and get your take. I'm really happy you're back. Your portfolio is kind of cutting edge right now for a lot of the AI that's happening, and would love to kind of unpack the way you're thinking about things. But before we do so, can you refresh us on the thesis at IVP and kind of the areas you focus most on?
It's a fun time to do this with you, Nick. This is year 20 for me, and the industry has matured and evolved a lot since I joined in 2005. And IVP has also evolved a ton since I joined 20 years ago. If you think about how to frame us, we really are specialists at the scale stage. And so the focus of the founders we are working with is very much about the supercharging of the growth of the business. And I think what we really, as a firm, only partner with a dozen founders a year. And we're managing close to $8 billion, and our current Fund 18 is about 1.6 billion. I think for us, what's been very special is at a time where I think I gave this analogy a little bit last time, but it's probably cemented more. At a time where everybody is sort of a multi-lane highway and everyone's kind of swerving into different lanes, from pre-seed to public market investing to, not just equity, but credit and wealth management and new business lines, we've sort of focused very much on venture capital. That's kind of the core of what we do. And we focus specifically on the growth stage because it turns out there's this interesting observation we have. There is a lot of capital, attention, and time put into the pre-seed, seed, and Series A stages where that's the getting something off the ground. And yet there's this abyss when companies hit kind of 10 million, 50 million, 100 million of revenue or traction, where that's really the difficult stage for a lot of founders. If you ever hear founders talk, they look back that scale point and say, that was really hard. And we had to make uncomfortable decisions. We had to take some pretty big risks where you're betting the company, kind of their version of the Intel, x86 moment, the microprocessor. They all go through that. And that's why it's important to have an active investor who's still on the board, who's helping out these entrepreneurs and their management teams in that scaling process, so that usually we're followed by the crossover funds, the mutual funds, and that's when companies are ready to go public. Their motion is a little bit more around really understanding the thesis and investing, and they're amazing, but they're less involved operationally and at the scale stage than we are.
And will you remain as owners, post IPO? Congrats on Rubrik and others, but do you continue to hold like life cycle, or do you strictly focus on venture capital and sort of pre-IPO?
Well, it's a great question. It's really situational, because in some cases, when we come in a Series D and the company goes public a little bit earlier than maybe we had imagined. We were investors in CrowdStrike, and we invested in, co-led a financing in 2017. And the business went public actually a year later. We take advantage of liquidity where you get it. Like DPI matters. We've had over 130 IPOs. We've distributed $4 billion, in the last few years. So we've had the ability to always send back capital when you get those windows, because they're not common in our asset class. But if we've come in later, we believe in the growth trajectory, we sometimes retain a certain amount of our holdings. And the most important thing philosophically is, even after we've distributed all of it, like in the case of a company like Snapchat, or in the case of a company like Coinbase, or in the case of Pure Storage, the relationships with the team and the founder are very deep and strong. And so our vision is that we'll always be a phone call away, a text away to help those people, because they're really the people that help us build our franchise. And we believe, even though we may not be technical shareholders, I still talk less frequently than I used to with Evan Spiegel, Snapchat, because there's a lot of exciting things happening there.
You've been doing this for a long time, and you've kind of been at the top of your game. You've seen a lot. How has the IPO process changed? And, I know you probably can't talk about specifics, but, in the current era, so few are getting through. We've seen like a 10x reduction in IPOs. How has that process changed, and from mechanics to strategy?
When I joined IVP in 2005, it was kind of right after a period where the dot-com bust had sort of been just ending as I was starting at IVP in March of 2005. And if you remember, Sarbanes-Oxley was created and sort of proliferated in the early 2000s, and that created a higher burden. It was it was essentially an instrument to create a bigger burden to decrease the frequency of the number of companies that go out and to increase the quality of the IPO baskets. It actually had a perverse effect, though. It created a lot more, frankly, revenue for compliance folks, audit, folks than probably like, created protections per se. I would almost phrase it as like it's inverted 20 years later. So back then, it felt like almost every company wanted to go public, but was just having to get through the Starbucks process. Now, actually, you have this real opportunity to go public because of some of the highest profile companies choosing to stay private and because of investors choosing to continue to double down at 100 billion, 300 billion, 500 billion dollar private market valuations, many companies are just choosing to stay private for a long time. I personally
is that still a control thing, or is it because we had this inflated pricing from a few years ago that so many companies still have to grow into?
I think it's less inflated pricing. I think it's control, but I think it's more philosophical. I think a lot of entrepreneurs will say, I don't need the capital. And if I can provide liquidity for our employee base and maybe some of our investors, early investors, then that also is a reason that typically people go public and you don't need to do that anymore. And I think candidly, a lot of people feel like we would have to naturally slow our growth. We'd have to make some trade offs and compromises. We'd have to be beholden to a series of public shareholders who only care about our numbers. And I would say, Nick, I disagree with that. In the case of Rubrik as a case study, Rubrik was one of the only companies to go public in 2024. They went public last spring, along with Reddit on the consumer side. And what they have shown is that there is a real strength. And if you tell your story in the public markets, you actually capture the imagination not only of new shareholders, but of customers. In the enterprise software space, when you're pitching the largest financial institutions, government agencies, and you have a public company, and people put you in a different bucket, I think you have more liquidity as a result of that. I think people say, hey, we want to do business with this company for 10 years. And if you look at Rubik's most recent earnings announcement, which came out less than 2 weeks ago, you could just see they've actually increased the velocity of both innovation and growth in the public markets. So this notion that I have to slow down, be beholden to a bunch of folks, I can't qualitatively invest in R&D is, I think, nonsense. I think it's actually incorrect. Public market investors are very rational. They're saying, hey, what do you want to build? What are you passionate about? What is the 5-year story? That's not that dissimilar from the venture capital process in the Series A and Series B. The scale is different. You have to report publicly, but the qualitative things they're looking for are very similar to what venture capitalists look for. I actually think venture capitalists have done a disservice by constantly discouraging companies from going public. I think the reality is it's not for everybody, but there's a lot of companies that when you talk to them on the other side, if you talk to, Evan at Snapchat, you talk to Bipple at Rubrik, you talk to Spencer at Amplitude, they'll all tell you it's the best decision we made is to go public. And we don't wish that we had waited. We're glad we went when we did. There's a line that Bipple said at one of the board meetings I remember, because people were giving me lots of advice. And he said, you know what I think is the best way to learn how to be a public company? Be a public company. Some of this is just experiential. You can hypothesize and do tons of non-deal roadshows and all of that. But the best way to learn is just get in there. And there's a really active public market looking right now to diversify away from the big tech names. They're looking at software. They're looking at AI. They have these tailwinds that they want to start building positions of scale in. And I think the longer companies wait, the burn just goes up. Right now is a great, I think, window to go out. The volatility notwithstanding of the last 8 to 10 weeks, I still think that you've seen offerings. CoreWeave went out, we saw this week.
Yeah.
And so there is a lot of interest still by the public markets for the best Silicon Valley startups to go public.
All right. So the best way to know how to be a public company is to go public. But with the IPO market slowly opening back up, what should companies be tracking internally as they start to think seriously about timing and readiness?
I'll give you kind of the quantitative way to think about it. The first is you want to be able to think about it sort of like a runway at an airport, where when a plane is landing or taking off, you generally want to basically fall within a range of that runway. You could be a little bit ahead, you could be a little bit behind, you just don't want to be off the runway. So with predictability, when you look at your core financial metrics, whether it's ARR and revenue, whether it's bookings, depending on your business model, whether it's gross margins, operating expenses, cash flow, you want to be able to predict 4 to 6 quarters ahead and have within a band of, call it 20 to 30%, some precision about where you fall. If you're wildly off your plan as a private company where you're like, I beat by 50%, I missed by 40%, probably not a great idea to go public. But the other thing is qualitative. I think some of the best companies I've seen create the practice of thinking and behaving like a public company, even while they're private. So at Rubrik, at Snapchat, and others, they would use the last board meetings before they went public to do mock earnings calls. Board members would do Q&A as if we were, public street, analysts. They would sort of do a ton of non-deal roadshows to simulate the process of being public because it's a different muscle. It's different. And those that start putting like everything in life, if you put the practice in, you're going to bear the results of it and just be prepared for it psychologically. And I think the best companies have shown the ability to do that.
So despite some activity and some progress like CoreWeave, you mentioned lots of volatility in the public markets, right? Yet seemingly little correlation with Series A. Like how do you square that circle, and what should we expect, I guess, in the venture markets at A and B over the coming quarters?
We looked at this at IVP over different cycles. IVP was founded in 1980. And so we've had the benefit over 45 years of seeing different cycles of boom and corrections. And I think there's a general trend we see, which is trickle down. The first thing that tends to correct is the public markets. When there's economic uncertainty, where there's war, when there's system shocks, Six Sigma events. Right now, if you look at kind of where we are as a country, we have multiple wars being fought, like actual wars, right? In Ukraine, obviously in Israel. We have a new administration that has come forth and is doing change, right? And some of that is on sort of what they projected, some of it's different. Tariffs, obviously, the markets are reacting to tariffs across the board, right? Which may have some very good long-term effects for certain industries, but certainly short-term, the markets are sort of saying, hey, there's a lot of volatility here. And so if you look at actually the top tech names right now, or the market cap of software, internet, crypto companies between $1 billion and $20 billion, there's a lot of volatility. We're seeing kind of double-digit daily changes in stock prices. And if you look at the VIX, the VIX is definitely a great proxy for how much volatility exists.
Yep.
Then you start seeing a correction in pricing in the kind of pre-IPO late stage market. So the series D, E, F. And so a lot of those companies are delaying IPOs. They're raising a little bit of cash before they go out if the markets are still volatile or they have to push the offering 3, 6, 9 months. And we definitely are starting to hear and see of price differences where somebody wanted to price at 15 times ARR, they're pricing at 10 times now, right? Just to raise a little bit of capital.
Is there a standard lag that you see with each of these series?
Yeah. It's usually, and it's not precise, but typically 3 to 6 months between each of the stages. And so by the time you get to the Series A, what we've historically seen is it's sort of 18 to 24 months after the volatility begins in the public markets. Now, with the world we live in, everything's just happening faster and information's more democratized. So we may be in a world where by the end of the year, Nick, we're going to see more deltas and changes in the Series A, Series B market than what we are now. It is also a world of, for all the listeners, there's kind of AI and everything else. And so in the everything else category, you are a more classical SaaS company, application layer selling to CHROs or kind of infrastructure focused. I think it's a reasonable time. The best companies get premiums, but they're not unreasonably priced. But I think if you are an AI company and deemed an AI company by the investor set, the valuations remind me a lot of what early cloud looked like, or crypto when Bitcoin was at its high and interest rates were zero. And I think the really challenging thing is I actually fundamentally believe AI is truly revolutionary, not evolutionary. I think there's the great quote, which is all great trends are actually overestimated in the short term and underestimated in the long term. I think we're both overestimating near term what happens with both AI, for humanity, but also for the companies, but grossly underestimating what the best companies are going to look like 10, 15, 20 years from now. And in the scope of history, Nick, I'm starting decade 3 at IVP, and it doesn't feel like that. It feels like I'm in year 6 or 7. And so even though 5 years sounds like eternity or 10 years, if you think about Facebook itself is 21, 22 years old. That's it, right? And it's replacing companies in the Fortune 50, Fortune 100 that are sometimes 75, 100, 150 years old. And so
The
Very
iPhone, less than 20 years.
less than 20 years, right? Perfect example. I think we sometimes get so caught up near term that we forget Uber, less than 20 years old, and look at a business that's worth between 150 and 200 billion, changed the world. And we were lucky to be investors in Uber. But my point is like, I actually think there's going to be a lot of companies that people look at the growth, they look at the market, and they say, this is the one. I'm plowing in money at a crazy price. And they aren't spending enough time with the founders. Because if you spend time with founders, one of the things that the two things we do systematically when we underwrite an investment, the first is you have to spend time in person with the founders and the executive team and really get a feel for what their motivations are. They can spend the entire hour you have talking about the numbers, but if you don't spend some time talking about the origin story, the qualitative goals, the challenges, you're not going to get a feel for what the ambition is of the founding team. The second thing is customers. When you talk to customers, and I am shocked at how few venture firms truly do customer diligence. Customers will tell you straight up, this is an amazing product. We just did something that we'll announce in a couple of weeks in the AI space that touches the legal, accounting, consulting industries. I'll have to leave it at that. When we talked to customers, they were rating it kind of 11 out of 10, 10 out of 10. Couldn't live without it. I would triple my budget if my manager allowed. And when you hear things like that consistently over 8, 10, 15 customers, that's truly the sign of qualitative product market fit beyond just the quantity. The numbers look good because the numbers can change. Things can happen in the competitive environment. The volatility of the economy can trickle down to decisions on buying, but it's the people part of it. It's how they support their customers. It's how, and especially in enterprise software, it's how they hire engineers and what they have them work on. It's how they communicate as leaders. That stuff matters the most.
Is there anything that's structurally different about this platform shift than previous? Anecdotally, it feels like this, I hate to use this cliche term, but this Cambrian explosion, the application layers taking off. But is there a fundamental reason why this shift will be bigger than mobile or cloud or even internet?
I think part of it is back to the revolutionary, evolutionary. Most of the evolutionary changes I've seen are more delivery advances, delivery model distribution advances. So if you think about SaaS, suddenly companies that were trading at single digit revenue multiples start trading at double digit ARR multiples. What happened? Two things. You're selling software as a service and you're creating, a new category of revenue classification called recurring revenue, right? Because that delivery model changed. But if you look at what the companies actually did or how much they spent on R&D, they were pretty much the same before and after. Similarly, there's certain cloud companies that were really essentially building in the cloud what they were building on premise before. And so again, it opened up an opportunity, but was it revolutionary or evolutionary? Now, I'm taking the best cloud companies in infrastructure, Snowflake, Databricks, they're truly revolutionary. What they've done actually, like none of the behemoths before them were able to do. And I think those are going to be some of the most powerful companies in software, especially Databricks, which we are not an investor in, but wish we were. And what feels revolutionary to me, about AI is that it is very much computer science based. It's technology based versus just delivery. Like you're fundamentally changing the mechanism by which bits are delivered. You're fundamentally changing the construct with which applications can be delivered. And if you look at our investing, we've very much focused on less of the modeling LLM layer. Our thesis when ChatGPT was announced in early 2023, we spent a lot of time on this, is it's going to be very difficult for startups to compete against incumbents or open source, right? Those two forces are going to probably carry the day in the modeling market, but it is startups that are going to win in the verticals and application layer that really matter, whether it's healthcare, education, gaming, and defense in sort of our four verticals we're looking a lot in the vertical layer, or we're investors in Glean, which you may be familiar with. Glean is actually focused on how do we increase productivity at work by creating the same search experience you and I have on Perplexity, one of our companies, or Google. Can you get that actually when you go into to IVP and say, hey, what is our policy for vacations, right? Or how many people came to our holiday party last year? These are the kinds of things normally I would go through Dropbox, I'd look for a file, I'd do Control H, Control F, Control B, and try to find it.
What a massive productivity suck that's been since, I've been in the enterprise world for all my life, and it's just a nightmare getting finding docs, getting access to the information you need. Consumer applications just make it look like we're in the Stone Ages.
And I'll add one last thing. If you think about the other killer app that we're seeing right now is code generation. So if you look at, companies like Cursor, Codium, I mean, it is remarkable what's about to happen. I think people are thinking about it from hey, this company's at 50 million, that company's at 200 million, they're raising at 4 billion, 5 billion. I think that's micro. I think macro, if you look at the world and you think about how many people are in the world, code generating AI startups are going to exponentially multiply the number of people that are exposed to computer science and development. So it'll make existing developers more productive. That's for sure. We're seeing that already. But it's going to bring into the market in the next 10 to 20 years, actually over, I think, 1 billion new people to this world that we all live in. And if you think about what that unleashes in terms of creativity and productivity, I think we can't even fathom that quite yet. Because if you have, at the application layer, if you have 1 billion new people across the world trying lots of different things using code generation as one of their tools, we're going to see improvements in climate, utility, energy, defense. What feels different for me about this cycle, you asked the question in AI, then when I started, it was really SaaS, Web 2.0, and then mobility, cloud, crypto, and then this. I think the biggest thing is global. I think people in the United States are not thinking about how do I build the best American mousetrap. They're thinking about how do I build the best global company. People sitting in Bangalore, people sitting in Singapore, people sitting in Abu Dhabi are thinking about not just how do I build the best company in the UAE, but how do I build a company that accesses the United States as an end market. So, and COVID, I think we have to credit in some ways COVID and remote communications for that, because I think because of the fact that you and I can do this, like using technology versus being in the studio live, it has just unleashed a sense that we're all globally connected. And so I see the founders I work with, this generation of founders is the most battle tested in my 20 years. They've been through, if they're in year 5 or 6, they've been through a pandemic. They've been through ZERP. They've been through the most brutal correction of the last 15 years. And now they've seen a complete platform creation and shift in AI. And they've seen massive volatility in the public and private markets. So there's not much that phases them. They're pretty tough. And of course, not to mention the kind of political backdrop of the last 5 years in the United States. So much has happened that I certainly feel what I've seen in the last 12 to 24 months dwarfs a lot of what I saw in my first 5 to 10 years in venture capital.
Does your support model at IVP change amidst the circumstances?
Yeah, it does, and it has. I think when I started, really the venture capital business in 2005 was very much kind of the solo operator model, which was, hey, I'm going to source, I'm going to diligence, I'm going to negotiate, I'm going to manage the legal close, I'm going to be the board member, I'm going to offer support, I'm going to manage liquidity. And I think what has happened in our industry is people realize specialization is the way to actually really offer the best product to entrepreneurs. So we have, different teams that focus on different parts of the business. And one of the key things we saw, for example, was each founder we work with as they're going through the scaling journey, they're typically looking for a few things. The first thing they look for is recruiting. They're always thinking about how do we up the talent level at our company as we scale? And if you get into the science of it, Nick, as you know, it's not just I'm looking for good people. It's what are the comp bands I should think about? When do we flip to RSUs? When do we think about the right, structure for the executives in terms of like, how do we think about liquidity and secondary? How do we think about taxes and wealth management? And there's a science behind it. We have a 4-person talent team now that came out of some of our best companies like Robinhood, some of the best executive search firms. So they spent all of their time working across our portfolio on just the talent side. And so that's kind of one area we've invested in. The second is
just to ask a question on that. Do you measure hiring effectiveness over time and hit rate?
Yeah, we do. We look a lot actually we actually have a whole Slack channel, as well as we built a custom thing around who is basically recruiting. We're essentially market makers. And so all of us in venture capital collectively are market makers. Who's looking for which role? Who do we have in the candidate database? How well are we doing on matching? How well are our comp bands predictive of where people ended up? And then can we actually, we're almost utilizing algorithmic thinking to make compensation more like a science at IVP. So
interesting.
As we get data, I'll give you a small example of this. I've been on many comp committees, and one of the most common first of all, like for anyone listening who's in venture capital, comp committees are time consuming, and you have to be very delicate because you're typically negotiating with the CEO about his or her own compensation. And you could do the job right by getting all the right data sets. But if you leave a CEO feeling undervalued, then you've lost the war. You may have won the battle, but you lost the war. And so it's very important to make sure you ask questions, you understand which variables are most motivating and empowering, which are sort of Achilles heel for the founder. So the reason I say all this is we have looked at performance-based compensation incentives for founders. And typically now what we're seeing is, hey, if you're CEO and you're year 7, 8, 9, 10, some of your compensation is going to be in the form of RSUs or options that are equity-based, time-based, meaning, hey, you're in the seat, you're CEO, you get 25, 50 basis points. And some of it is performance-based. Hey, if you get liquidity at an IPO valuation of 3x the last round, 5x the last round, 10x the last round, you have tranches that open up because it's tied to kind of shareholder value appreciation. So the reason I say all this is like the average person isn't thinking about all this when they think about what's going on behind the scenes at some of these companies. But as a board member and an active investor, we enjoy it. We love that. The other part I'll share with you is we've hired venture partners who are functional leaders in areas. So we hired recently Kevin Egan. Kevin was actually one of the greatest go-to-market leaders I've worked with. He ran go-to-market at Dropbox and Slack, which we were investors in both companies. And in the last 4 years, his chief sales officer at Atlassian. And Kevin just understands that one of the biggest things that founders focus on is how do I scale my go-to-market engine? How do I make those hires? How do I instrument the pipeline? How do I think about the tooling? How do we think about the customer engagement? And that's another almost, subject area. So Tamar Yahushua was the same thing for us, venture partner. She was a product leader at Slack and was at Google before. She now is president and head of products at Glean, one of our companies. So we have this other model of world-class operators partnering with the functional leaders at our top companies. Ventures, I think a business, you have to be active for 2 reasons. The way you really get to showcase the value add is just by the day-to-day engagement. It's not just you show up in a board meeting, you kick your feet up on the table and you offer 2 sound bites and you leave until the next quarter. That world is long gone, right? And so I think people who think that, if you actually ask founders, that is not helpful. What is more helpful is when a founder has a crisis, that you're one of the first people they call and your firm delivers quickly and highly effectively. The second thing that I think has really, dramatically changed is the speed. I think you can't just sort of expect that things will get solved overnight. We had a CEO forum in last October in Napa, and the common theme I heard was you're constantly refinding product market fit in this AI era. You can't just assume because I just went public, I just raised a Series D, that we're in steady state from then on. The amount of disruption and change, we saw it with DeepSeek, that just can happen overnight, with distillation and DeepSeek. That's an example of how you can't take anything for granted in this world of AI.
How do you deal with style differences, right? You're trying to help out a founder. You've got best practices, you've got go-to-market resources, you got talent resources, but everyone's kind of their own unique snowflake, right? I know you work with Shiv at Bridge, and he's such a unique visionary, right? And he's just one. You work with a lot, right? But not everyone has the same style. Some people are more results focused, some people are more process focused. How do you navigate that?
I love this question because I think it's actually a more higher order philosophical question. I think the 2 things I grew up loving were sports and music. And there were 2 different philosophies in both those fields. In music, a lot of training in music is classical based, right? And in classical music training, you have a score that was created 400 years ago, and there's technique that you have to use to play that music perfectly. And there is not room for improvisation. Mm-hmm. But I also was exposed to jazz. And I think in jazz, what you find is that there is structure and there's parameters, but then it gives each individual the ability to improvise. And there are some people who hate jazz, and there's some people who love it. And I found I appreciate classical music a lot, but with jazz, I enjoyed the creativity that came with it. Same with sports. There's some people who say, I have kids who are, dealing with this every day. Hey, by the age of 10, your 4th grader better pick the sport, be a 1-sport athlete.
Right.
And I said, why? oh, because at this point, they got to be year-round baseball, they got to be year-round basketball, they shouldn't play any other sport. I like fundamentally disagree with this. I think the beauty is, hey, if you're the next Steph Curry or Derek Jeter, sure. But we both know probabilistically that's very, very unlikely. And even they would tell you, they didn't know that that was going to be their thing until later. And they benefited from trying different sports and just loving being outside and being an athlete. So, you know, I, I had two kids who played different sports, and I'm proud of that because I think it gives you versatility. How does that apply to the question? With founders, Shiv, practicing cardiologist, extremely, extremely brilliant. The way I communicate with him is different than Arvind Jain, a second time founder who was an engineer at Google and co-founded Rubrik, where I got to work with him for the first time, and now Glean. And they're all a little different. And I think it's a little bit like jazz. Part of the fun of it is realizing that you have to improvise. You have to think about investor founder fit. What is the right way to communicate? There's certain principles that they have or we have. We can agree those are the parameters. But within that, I think what's fun about it is that you have to really think about who your audience is. And this is why enterprise software companies, software founders are the best coaches because they're always thinking about listening to their customers, right? Like,
Mm.
If George Kurtz at CrowdStrike wasn't, running CrowdStrike, he'd be an amazing executive coach. He'd be an amazing mentor to founders, right? And Ali at Databricks, another great example where, he has advised a few of our founders, and they always just say that 30 minutes he spent with them is transformative because he's such a good listener
Hmm.
and he understands very well how to give them the right advice at the right time when they're ready to receive it. So part of, I think, what I've honed over the last 20 years is realizing that everyone is a little different. And I'm not the right person for certain companies in certain situations, but I can help them hopefully figure out who is and get them to that person.
Somesh, you mentioned DeepSeek and distillation. Would love to touch on that a bit. There's been lots of coverage of DeepSeek and distillation approaches last month. What do you think distillation and other wrapper techniques mean for the model layer?
Well, if you'd asked me the question in January, I would have had a different answer than February, and now we're almost in April. So my current thinking, which has evolved a bit, is I think so fundamentally, just so people have some context, I think DeepSeek had been around for a while, but essentially there was almost a Chat GPT like moment about 3 or 4 months ago where they were able to replicate. This is a Chinese product, and they were able to replicate a lot of what ChatGPT and OpenAI had developed through kind of hundreds and millions, if not billions of dollars of invested capital. And I'm not going to go into the specifics. I think it's now well documented about where they did it, how they did it. I think the bigger thing is, I think open source as a philosophy and a concept is going to win. And I think if the only thing you do is we're going to have a slightly better version, it's a little bit like iOS. Like if you think about it, why is someone buying a new iPhone now? Like, kind of almost 20 years after the original iPhone came out. It's probably less because the camera's slightly better, the chip's slightly faster. You certainly are not seeing the price increases you used to. It's primarily because in the ecosystem they live in, there's probably 5 killer apps that they use their iPhone for that they just can't ever let go of. FaceTime. I actually think FaceTime is the most underappreciated application that iOS came up with because it connects human emotion, it connects families, friends, and community. And I think that's the reason why, even though there's so many rational reasons for people to switch from, an Apple to a Samsung, iOS to Android, that app native has basically created so much retention for Apple. I see it in my own family where like rationally, and everything else, people are very price elastic. And yet when it comes to like going to a Samsung Android phone, people are just unwilling to go.
Not even a discussion people are willing to entertain.
Totally. So I kind of think part of my own thesis of how this all evolves is it's the data itself that's going to be very important. So like back to the verticals, if you're a healthcare AI company, education AI company, there are repositories of data or data creation that's going to be very, very valuable. And if you have access to some of the biggest treasure troves of data, whether it's NIH in the UK or some of our big health systems in the United States, or you're at the point of care, you're a doctor at Kaiser, like a bridge, it works a lot with Kaiser, and you have the ability to actually have those patient interactions over 10, 20, 30 years, your doctor, Nick, is going to have, and the software layers around your doctor, the wrappers, they're going to actually be really valuable because they're going to know who you are and what your body is saying and doing. And so I think that's the part of it that people are missing. I think there's too much emphasis on the latest version of the model and too little on like the proprietary nature and the quality of the data. I think open source actually is less. It used to be we worked on MySQL at IVP. It was one of my first investments I got to support on, and I realized in that investment and many others, it was more a philosophy of giving developers agility and choice. Red Hat had been sort of the best example of it before MySQL, but if you looked at the infrastructure layer in software, open source worked actually for a couple of the key elements, application server, database, and it worked less so for other things that were kind of more proprietary. Like Sugar CRM did well, but it's hard to argue an open source CRM solution far outpaced Salesforce. And part of that may have been just execution and company and timing. I'm a firm believer though that like people are going to leverage these open source models. It's going to feel like an app store where like at some point, if you're a Fortune 500 company, you don't want to sit here and have to like figure out what has the best of breed versus point solution for all these different models. You're going to essentially have sort of like a turbo mode that's going to take basically the functionality you need and apply it to your business use case or your particular vertical you're trying to build in if you're a developer.
Yeah, I mean, I was reading an article where one of your CEOs of Glean was talking about this very issue and how open source he thinks will thrive in the AI age, and funny enough, even Sam Altman was quoted and said, personally, I think we've been on the wrong side of history here and need to figure out a different open source strategy. It's kind of shocking.
It is shocking. And I think, but we shouldn't forget, I think people get very binary. So they say, okay, OpenAI is closed source. It's over, like Sam, and I think if you think about, I'm deeply respectful for what OpenAI has done is in a lot of ways, they kind of evangelized AI in the way that Apple evangelized mobility, right? They've evangelized, they've become a company that the brand is so synonymous with the sector that the first question in most board meetings of Fortune 500 companies is, what are we doing with ChatGPT and OpenAI? And there's an intangible benefit of that people are underestimating. And so if you think about it from that perspective, Amazon, similarly, when they got into AWS and then moved into cloud services, the advantage they had was just the branding enabled them to quickly accelerate sales cycles, get in with the key CIOs and CISOs, and be able to sell a lot of projects and software that a normal startup wouldn't be able to compete with. So I'm actually bullish about OpenAI, although I think they're going to go through obviously evolutions in what they focus on and sell, but I wouldn't underestimate what they built. I'm also bullish on Anthropic. I think what I'm less bullish about is LLMs 3 through 100 because I think they have the capital, the scale, the technical talent that basically enables them to compete with the very best large tech incumbents. But if you're a subscale LLM, and you're not going to be able to get the capital, you won't be able to retain the good talent or recruit the good talent. You won't be able to actually develop fast enough to outpace, the Microsoft projects or Meta projects. So I think that's where venture capitalists who put a lot of capital into it's interesting because I think there's one unifying philosophy I've seen over 20 years. It's sometimes a capex heavy venture investment can be good, but usually it's not.
Hmm.
OpEx is usually the best recipient of venture capital dollars because if you think about it, just for people listening, when I started the first summer I was there, we looked at clean tech as a market, and I was 25 and I was trying to figure this out, and I was digging into it, and most of the hundreds of millions being poured in was used to build ethanol factories, to build, different methane production mechanisms. So very capital intensive things that I was naive. I just said, why is there no debt for this? Oh, it's very risky and it's also extremely capital. I'm like, well, the debt markets don't want to touch this. And then is there a public finance for this? No, even the public finance, like bonds and munis, don't want to touch this. Whoa. And so when it's that risky and it doesn't develop bits, genuinely, usually it doesn't work out. Now, there's classic examples that are counter that, NVIDIA being a great counter example, AMD, obviously, more recently. But I think, like, generally the consumer space, the internet space, the fintech space, the enterprise software space, the best companies are actually quite capital efficient. And, if I think about Discord, which we've been involved in for about a decade now, for many years, they were able to get to tens of millions and then 100 million users with a very, very tight knit, highly productive engineering team. And you didn't need to have, for that product and that service, 5,000 engineers, you could do it with 50 to 100. And I think that enabled them to have just a healthier, accretive path. They weren't diluting quite as much in stock-based compensation. They weren't burning quite as much in pushing out profitability. And so I think you see that healthy path and trajectory. It gives founders more weapons at their arsenal when they're not constantly fundraising and constantly diluting. I think they're creating more shareholder appreciation for everybody. I'm a I think we'll see in hardware companies a few who think about hardware as a mechanism to build a great system. A system will have software, hardware, and data. Many of those companies will be very successful, but a pure hardware company that's extremely capital intensive, I'm not sure VCs investing big chunks of their fund at very high valuations are going to be happy with the end result.
So if we stay on that thread and talk OpEx, the application layer is kind of finally having its time in the sun, and we're still very early in the cycle. How do you frame the opportunity at the application layer, and where do you see the most interesting areas to invest?
One we touched a bit on. So I just continue to think after the pandemic and what we're seeing with the United Healthcare incident, if you think about a lot of what we read about broadly, Americans want better health outcomes. Our system has failed us. Candidly, I think the American healthcare system, nobody, even its greatest believers, will say it's perfect. It's not even close to it. And I think AI is actually going to be the platform that helps more than mobility, more than software, bring the American health system to just a much better place. In the case of
Diagnosis alone is like advanced, I don't know, 1,000, 10,000, 100,000 fold when you use AI?
Yeah, if you think about philanthropy has covered up for the private sector to a large degree to help with rare diseases or things like, tuberculosis, malaria around the world. But, even now, if you think about the business model of large pharma, Nick, the economics to go through the clinical trial FDA approval process and make something that helps solve a rare disease. And the way we classify rare disease might actually be, 1,000 to 10,000 people a year afflicted with it who are debilitating. And we don't solve for that part of the population anymore because of the economics, right?
Yep.
So
orphan drugs and whatnot. Yeah.
exactly. So some of the companies we're meeting are using AI to basically enable faster drug discovery and delivery in those areas. Bridge is a great example where I actually really got to know about the company from my brother-in-laws who are physicians, and one of them actually works at Kaiser. And he was just sharing his experience using a tool like a Bridge is, hey, 30 to 40% of my time is spent on administration, actually like note taking, reading the notes, prepping, sharing with my clinical team. The fact that I can save a big chunk of that now gives me more time to spend with patients and my family. And if you think about our physician population in the US, they're the most important group of all, right? They're frontline workers in healthcare. And if you think about kind of where they're at, why do they practice medicine? If you talk to any of your doctors, it's because they love treating patients. They actually like the clinical part of it. And yet, somehow we've gotten to the point where many of the most successful ones are doing very little of that. And so, if AI can enable more automation and digitization of the, call it administrative clerical parts of the job, so they could do more with the patients, they're actually happy. They're earning more income, which they deserve to. And they're more productive. So it's kind of like that's one big use case that we're seeing at a Bridge and we're excited about. The other one's education. I have kids in school. And if you think about the data set right now, we have more American children with learning disabilities than ever before in our history. We have more children with mental health acuity issues than we've seen before, for a variety of reasons, which are well documented by, Jonathan Haidt and others in the Anxious Generation. Social media, violent video games, smartphones, proliferation of devices, cyberbullying. All of this has led to like a tough situation for our kids in America. But if you think about like what if you think back, Nick, to your educational experience and you close your eyes, I'm guessing you think about a couple of teachers that really made a difference. You think about how somebody engaged with you that inspired you in the subject area that you're probably still passionate about, believed in you when you were doubting yourself. And where AI can be really helpful is this idea that every kid can have a personalized tutor, coach, co-pilot. And Some people are visual learners, some people are auditory, some people are night studiers, some people are morning crammers. Some people need notifications to remind them to do things. Some people like to have that stuff turned off. But every kid learns slightly differently. But this is basically a big machine learning problem at scale. The reality is how you and I learn history may be different, but if we can actually utilize this technology to have kids have mental health co-pilots, education co-pilots, I think we come out of this with a population of kids in America and around the world that are going to learn a lot more and enjoy and be curious people in a way that has kind of been lost with our education system today. Standardized tests, while I think they were developed with the right orientation, they miss the ability to actually create it, like foster a curious and creative mind. And
Yeah.
I think that's where I think AI plus gaming together and with education can really help. I think there's some studies you probably have seen where some autistic kids have actually found that certain types of games and certain types of exercises that AI is now enabling to personalize are enabling better clinical outcomes for autistic kids than without.
No kidding. Yeah, I'm always curious what the future looks like for AI native children and their relationship with technology. If there will be an emotional relationship, if they will just grow up with a different mindset than we had, and I don't know if that means that their relationship will be closer to the AI or treat it more as a tool. It's just kind of hard to wrap your head around.
Every generation regroups and refocuses, and I think there's always going to be change. It's just happening a lot faster. So I certainly think our kids' generation may actually reject in 5 to 10 years a lot of the social media platforms. If you talk to a lot of kids, they recognize today the harms that are there on the internet and social media. They get it. And I think they're trying to think about how do we balance this with the fact that we have smartphones and laptops at schools and colleges, and we have to like text our parents, but then we're getting weird texts from friends. Like there's all of that we talk about as parents. I think the relationship though with AI is going to be more natural and organic where, hey, look, if I have a therapist and I'm on the board of a company called Lyra Health, which does a lot in mental health. And if I have a therapist and I'm used to talking to them live, sometimes you just need somebody or a prompt or a reminder or a visual in the middle of the night when you're feeling anxious or on the weekends when your therapist is not around to give you that reset to be able to continue through and power through what might be doubt or anxiety or lighter forms of depression. I think that's where, whether it's dating, whether it's religion, whether it's mental health, our kids' generation will very organically be able to couple the digital world with the analog world in a way that's
Mm-hmm.
harder for us to do because we grew up in a much more analog environment. But I actually think our generation isn't like most of us are also open-minded. I don't think we're gonna reject everything and say, "Hey, I just want everything to look like 1980 again." Some people will, but like I think I actually think I'm excited for how to make my work more productive with companies like Glean or how to make knowledge easier to access through Perplexity. There's lots of things. Defense is another space we're spending a lot of time in. I just think the amount of cyber attacks happening, I think modernizing the US's arsenals in different areas of land, sea, and air. I think new age startups using AI are going to be able to do amazing things that maybe the primes aren't the best suited to do anymore.
I mean, it is an amazing time to be alive. Like the speed of technology innovation is remarkable. I remember growing up and being frustrated with so many inefficiencies around me. It was just like I don't know. I see problems in a lot of the things that I'm trying to do in workflow. And it's just incredible what we've been able to accomplish. My buddy was talking about his self-driving experience with his Tesla the other day, and it's just unreal. And so despite all the noise and political issues and polarization and social media can be a challenge, we're really living, I think, in the golden age of human existence.
Look, think about Waymo, Nick. I mean, you and I get to see Waymo, but when I was talking to a relative in India recently, he was so fascinated with the fact that it exists, it functions, people are finding great use cases. We're seeing it trickle down to different parts of the country. I think Waymo has the potential to completely modernize and upend this ride sharing world we live in. I think Uber is going to do just fine as they modernize themselves and harness and adapt it. But if I think about my biggest fear as a parent is like kids, the ability to drive, the substance use that happens sometimes when people make bad decisions when they're younger, whether it's prescription drugs or alcohol. I actually like the idea that a Waymo, more than an Uber, is going to be there for my kids to take them from point A to point B locally,
Totally.
I think that's pretty phenomenal. And I'm just really like, I was just thinking to myself, like, is the DMV going to be as relevant like 20 years from now? Because like, are people going to buy cars? And if they have Waymos available everywhere and at a price that's cheaper than car ownership, we already saw with Uber, a lot of younger people who live in urban areas they don't have cars, and it makes sense. But I think with Waymo, it goes even further where the economics can trickle down exponentially, where it becomes, so easy to go from point A to point B that it's kind of $2, $3 to go 3 to 5 miles. I mean, at that point, none of us are probably going to invest in cars as we used to. And if you keep having these tariffs, maybe we won't have to.
100%. Yeah. Funny enough, so we pulled my son out of school. We're doing a semester of homeschool. He's like a couple grade levels ahead. So he's a second grader, but he's late fourth grade in math and reading. And so we've been traveling. And we went to San Francisco. And one of the things I wanted to make sure that he and my wife did was ride in a Waymo. And they had this experience. They just took it like 2 blocks. Like they did a big circle. But they got out and my wife was like, her eyes are wide and she's blown away. And then my son gets out and I'm like, what did you think? And he's like, no big deal. So for him, it's like, this AI native generation where it's going to be normalized. Like it's not going to be this shocking, experience.
Absolutely.
So going to throw you a bit of a curveball here. We've been talking about healthcare quite a bit, and you invested in an AI startup, Abridge. They're kind of revolutionizing physician experience, as we've kind of touched around a bit. But this founder, Shiv Rao, right? He's very unique. I read this article about him taking these side quests, including recruiting a magician to his cap table, pursuing an eclectic interior designer for Bridges' offices, and of course, meeting the elusive music producer, Rick Rubin, who's one of my favorites. So we all love visionaries. We all love nonlinear thinkers, people that borrow and steal great ideas from other domains. My question for you is, number one, when you're evaluating a founder, especially at the scale stage, what are the signals you're looking for that really make you lean in? And then in the case of somebody like Shiv, how do you distinguish between brilliance in visionary folks and maybe those that have a lack of focus?
Entrepreneurship in my mind, Nick, is like I said, it's a marathon. And I think those that are truly exceptional, the pace at which you have to dedicate yourself, change your life, none of us can fully comprehend it who aren't doing it. It is I think among the greatest sacrifices that someone can do is to become a founder. The people like Shiv who are founders can always take an easier path. I think about the Robert Frost poem, right? The two paths diverged on a path, and I took the one less traveled by. I actually think they're so talented, but they see the world with a different prism. And there's something that's so not financial status, ego driven that really propels them to greatness. So in our process, a lot of what I do is I like to hear the origin story. I like to hear a little bit about how do you hire people? What do you look for? Right? What do you spend your time on? Right? Because you could do lots of things, but what do you choose to spend your time on? And the key thing, actually, one of the great piece of advice I got from a mentor of mine was you want to first make an assessment of where a founder is today, because that's part of the investment thesis. Hey, we're going to invest in the Series B. We got to figure out this founder. But a really great founder is one that also matures and evolves and is so driven to make his or her company successful that they're willing to take feedback. They're willing to be so self-determined to mature that they're unrecognizable. Like Mark Zuckerberg, I met I think it was my first month at IVP, March of 2005 for the first time. And if you see him 20 years from now, you wouldn't have no one would have imagined. Like he's so much more polished, than he was when I first met him. I had the advantage of growing up in Silicon Valley, and I had the advantage a lot of my friends, or when I was at college at UC Berkeley, you would see founders come and they all have certain quirks, right? They're not the suit and tie corporate executive at, AT&T. Like they're just a different breed. They're very, I think, effective when they have those people at their companies and they scale, but I just fundamentally believe founders are the glue that keep the Silicon Valley ecosystem going. So in the specific case of Shiv, my first reaction from him is, my goodness, this guy is truly brilliant. He's a practicing cardiologist. He still sees patients once a month at UPMC, and I talked to a mentor of his who said, And he's not just he's one of the best cardiologists. Like clinically, he's unbelievable. He is somebody who, you know, understands design engineering thinking. He also worked for a while in venture. So he got to see a lot of startups before he started his own company. He worked at UPMC's venture group. And I think most notably, he's a curious person. Most of the great founders I have had the chance to meet or work with are deeply curious. And I think so you were kind of looking at the what and that, what did he do? Oh, he, brought Rick Rubin, the amazing Rick Rubin, to his first conference last fall. He brought a magician to cap table. I think about the why. So why did he do that? Right. That conference that he held was really about not doing the typical dog and pony show of saying, hey, we're going to bring a couple doctors, a couple government folks and just create a dog and everyone goes home. It was about trying to talk about people that are truly transformative and path breaking, because that's what, a bridge is aspiring to be. And, Rick Rubin's talk was just spectacular, actually. And so the same thing goes with the design. It's about creating an environment. And this is, if you look at early stories of Sun Microsystems, I heard this really good one from Scott McNeely a few years ago, where he said, when we got our first customer, we kind of wanted to look bigger than we were because we're this tiny little startup, but they thought we were like the same scale at IBM. So they were able to talk to, I think, their commercial real estate landlord and say we're in building 4, even though there's only one building, just fit a whole metropolis or something when it was actually just one little floor of one little building. I think that's the beauty of, taking on the Goliaths of your David, is like you always have to sort of fake it until you make it, in terms of like really creating, creative ways to sort of put your best foot forward. I've learned from Shiv every day. I learned from Jason at Discord every day, Evan at Snap. I mean, that's the true privilege I think I've been able to get after 20 years. And every time I see, you ask me like what motivates me at this stage, when I look at an Uber, that my cousin might be taking, or I get to see a doctor using a bridge, a small part of me, that's the real joy out of anything, is like, I was able to help those founders get those products to the market. And that's just really special.
Somesh, if we could feature anyone here on the show, who do you think we should interview, and what topic would you like to hear them speak about?
Well, since we talked about it, if you can get Rick Rubin, you should get Rick Rubin, man.
I know, right? That would be amazing.
I think, in the entrepreneurial world, I would probably say, since you brought him up, Shiv would be amazing from a bridge, because he's just such a fascinating person in both with the work he's doing in AI as a cardiologist, or Arvind at Glean, or Arvind at Perplexity. Those three, if you AI founders, that's the triumvirate that I just think are really exciting to work with and listen to. And, as an investor, I have to say, my friend Sarah Guo at Conviction, I think she is doing an incredible job in helping companies in the AI space. She's got an awesome podcast, No Priors with Elad. And I think it's one of the first kind of new platforms focused on AI that came out at the right moment that the market was shifting. And the combination of just, she's an amazing board member. She's a great Sherpa to founders. And I think she has a great portfolio. I think she would be a good person to talk to.
Awesome. What book, article, or video would you recommend to listeners?
Well, we talked about lots of things, Nick, but I think Never Enough was the book I was thinking about when we were talking about the culture now for our kids of kind of overachievement that's become toxic. It's by Jennifer Grisham Wallace, and it's a really good book about how our education system has changed, how homes should actually be supportive to our kids versus even more pressure creating. So that's one good one. In venture, I just reread it actually summer. I really like it, but The Power Law by Sebastian Mallaby. It's really probably the most well-written book, and I'm a big fan of Sebastian's, about the asymmetric risk return that drives Silicon Valley. And I think if you're not from here, you're like, why are people paying these crazy valuations for these illiquid, unprofitable companies, right? And the joke was, someone was like, oh, I just focus on nonprofits. And I was like, yeah, I do too, right? Because almost all the companies I've invested in are also unprofitable. But I think the reason is the returns for the best companies here are just, they so make up for everything else that's why the business operates, the industry functions the way it does. So I love the stories that they told. Reed was in it, IVP's in Inception, but also Sequoia Capital, Michael Moritz and others. Like, just really a great read.
Awesome. Somesh, do you have any habits, tactics, or behaviors that are a force multiplier?
We were talking a bit in this conversation about jazz music. I've kind of rediscovered my love of music. I loved music growing up. Somehow I lost the ability with young kids and a busy work to discover new bands, musicians, genres even. And so I subscribe to a Substack called Flow State. And it's got a lot of, every morning I get one album and one band kind of recommended.
Hmm.
And it's in different genres from jazz to ambient to trance. And it's just, as someone who has eclectic musical taste, it's been really fun for me. I think it's correlated also to just venture capital, because when you go in every day, Nick, like you and I do, you could be meeting a company in AI therapeutics in one morning, and then in the afternoon you're meeting a SaaS company selling to CHROs. It's actually the most exciting thing is the context switching. It's not for everybody. Like some people hate that, but for me, I love it because I'm constantly learning about new industries and new delivery models and new business models. And especially because I get to hear from just these unbelievable founders about what they're building.
Awesome. Love it. And then finally here, what is the best way for listeners to connect with you and follow along with IVP?
I would recommend LinkedIn. I love LinkedIn. I'm sort of a power user. So definitely we post a lot on the IVP LinkedIn side. I try to do my part and throw in some interesting content from time to time, but that is probably the easiest. Do not email me. I am not good at responding more to email. It is just a labyrinth and a mess. I hope AI will enable, we have a company Superhuman that's done some great stuff in email, but we also believe there's going to be lots of new tools that will hopefully enable more throughput on email for all of us knowledge workers.
Awesome. Well, Somesh, thanks for returning to the show. If you're listening now and you want to check out the original episode, I'll put it in the show links. But Somesh, this is great. Congrats on all the success with Rubrik and many others. And looking forward to having you back sooner next time. We shouldn't wait
please.
4+ years, you know.
Nick, thank you for having me again. I don't take that lightly. It's so wonderful to be with you and also hear of all your success. And I just think it was such a fun conversation. Thank you so much.
Thank you, sir. Appreciate it.